The supplemental practice problem for Chapter 12 gives us different returns over a 5-year period of time and asks us to compute the arithmetic return and the geometric return for this 5 years. For the arithmetic return, we just take a simple average, add up these returns, so the sum of all those returns is 18%. I divide that by the 5-year period of time over which those returns occurred, and I get a 3.6% arithmetic return for the 5-year period of time. For the geometric return, I need to compound all those returns across the 5-year period of time. So let me create the compound result by adding 1 plus each of those returns and multiplying them together. So I took 1 plus the 12% rate, 1 plus the 17% rate, 1 plus the negative 8% rate, 1 plus the 3% rate, and 1 plus the negative 6% rate. And there is some singular geometric rate of return that would be compounded. So this is a one number, a singular number for rate of return, the geometric return, that when added, when a 1 is added to that return, it would compound 5 times because this was a 5-year period of time, and it would equal the same thing as the product of 1 plus all those 5 individual rates of return. So the product of 1 plus all those individual rates of return is 1.167231, and there's some singular geometric return that could compound 5 times and produce the same growth as the product of 1 plus all those different returns there. So to get the geometric return by itself, then I would need to get rid of this exponent, or get an exponent of 1, I would need to take the 1/5 root of both sides of this equation. A quickie exponent review might be helpful here. If we have a base that is raised to a power, say a, and that is further raised to a power, say b, so we have the base raised to a power, and that is then raised to a power, then we multiply those exponents together, so that would be the same as the base raised to an exponent, the exponent being the product a times b. So in this example, where we have 1 plus that geometric return, that was raised to the 5th power, and then we wanted to take the 5th root, or raise that to the 1/5 power, then that would be the same as taking 1 plus the geometric return and raising it to a power equal to the product of those two exponents, which of course gives us the exponent of 1, getting the 1 plus the geometric return by itself. So we can solve for that geometric return very easily from that point. So 1 plus the geometric return would be 1.167231 raised to the 1/5, or the 0.2 power. to get the geometric return by itself, I would take 1.167231 to the 0.2 power and then take the 1 back off. So we could use the exponent key on our calculator to do that. So let me first verify the product of all those returns that when I added the 1 to them. 1.12 times the 1.17 times the 0.92 times the 1.03 times the 0.94. So I've taken 1 plus each of those annual returns and gotten the product of 1.167231. I'm going to take the 5th root of that, or raise that to the 0.2 power. So I'll use my y to the x key with 0.2 as my exponent. That gives me 1.0314. I take the 1 off, and that gives me 3.141% for my geometric return. So I could apply an annual rate of 3.14% for each of the 5 years, and that would be equivalent to gaining 12, gaining 17, losing 8, gaining 3, and losing 6%. So let's verify that for a $10,000 investment. Just arbitrarily, I chose $10,000. If that was to grow at the different returns given in the problem, increase by 12, by 17, lose 8, gain 3, and lose 6%, then over the 5 years we would just be multiplying that by 1 plus the 12% return, and 1 plus the 17% return, and 1 plus the negative 8% return, and then 1 plus the 3% return, and finally 1 plus the minus 6% return. For a $10,000 investment, then that would grow to $11,672.31 over that 5-year period of time. That geometric average return that we calculated for the 5-year period was 0.03141%, 3.14% rounded, but let's keep that extra decimal place here. So our geometric average return was 3.141%. If I add a 1 to that and compound that 5 times, because it was a 5-year investment, then the $10,000 would grow to that same $11,672.31. So again, this 3.141% geometric return was doing the same work as gaining 12, gaining 17, losing 8, gaining 3, and losing 6%. In problem 12.2, it says an asset has a mean return of 10% and a standard deviation of 5%. What is the probability that the asset's return will fall between, for part A, 5% and 15%? If we draw our normal distribution, you remember it's centered at its mean return, which in this case is 10%. And with a standard deviation of 5%, we can move to the points that we're asked about by going down 1 sigma below the mean and going up 1 sigma below the mean. So the mean of 10%, we go 1 sigma down to 5, 1 sigma up to 15, and as we mentioned in the lecture, 68% of the outcomes for normal distribution fall between the mean minus sigma and the mean plus sigma. So 68% in Part A. In Part B, it says how much probability would be between 0% and 20%. Again, the distribution is centered at its mean of 10%. This time, to get down to the 0 that we're asked about, that would be the mu, or the mean, minus 2 sigma, and to get up to the 20% that we are asked about, that would be the mean plus 2 sigma. And for a normal distribution, the probability falling between the mean minus 2 standard deviations and the mean plus 2 standard deviations is 95% for any normal distribution. So we started at the mean of 10%, and with a sigma still 5%, we had to go 2 standard deviations below the mean to get down to 0, and 2 standard deviations above the mean to get up to the 20%. And 95% of the probability falls between 0 and 20%. In problem 3, we're given a few situations here related to the efficient markets hypothesis. In Part A, it says an investor earns abnormal returns by reading articles about a company in the newspaper. Well, if you can use publicly available information to outperform the market, then that public information is not reflected in stock prices, so the market would not even be semi-strong form efficient in this case. At best, it would be weak form efficient. Now, we don't believe that you can just read newspaper articles about a company and go outperform the market. So we do believe the market is semi-strong form efficient. If you could outperform the market by reading public newspapers, it would not be semi-strong form efficient. At best, it would be weak form efficient. Again, we believe it is stronger than that, but in this scenario, at most, it would be weak form efficient. In Part 3B, it says an investor earns abnormal profits by using inside information they have about their employer. The market is at best semi-strong form efficient in this case because the investor is able to earn abnormal profits by using inside information. So we have said nothing to take away semi-strong form. Semi-strong says public information is reflected in stock prices. This investor earned abnormal profits by using inside information. If the market is strong form efficient, inside information is reflected in stock prices, and it could not be used to earn abnormal returns. Since this investor is earning abnormal returns using inside information, the market is not strong form efficient. So at best, it is semi-strong form efficient in that example. Now in Part 3C, it says an investor is unable to earn abnormal profits using inside information they have about their employer. If they're not able to earn abnormal profits, then in this case, the inside information is reflected in the stock prices now. And that means that all information, both public and private, is reflected in the stock prices. So if all information, including inside information, is reflected in stock prices and is not of value, then the market is strong form efficient, meaning that all information is reflected in stock prices. And that's it for the supplemental problems for Chapter 12.